The stock market boom is over.
It's over.
And recent price action is looking extremely bearish. In the housing market, a lot of the crazy speculation is gone, but we're only in the early stages of interest rate hikes. So what does this mean for house prices? Well, I'm Biko Konstantinos, and that's what we're going to talk about today. Thanks so much for stopping by, and please give this video a like. If you're interested in keeping up to date on the market from an independent viewpoint, please consider subscribing to my channel. I'd love to have you on board. Let's learn together so we can be best placed to navigate this extremely volatile financial market. Now let's see why recent action in the stock market could have a profound effect on house prices. To see where the stock market's at, I'm going to have a look at the NASDAQ, which has been the market darling over the past couple of years. After the dot-com bubble in 2000, the NASDAQ went basically down and then sideways and hit this low point in 2009, which we call the start of the boom. The NASDAQ then showed a very nice uptrend up until COVID, which hit in 2020. Now the COVID downturn on the NASDAQ only really looks like a blip in this long-term chart. So after that short-term blip, the NASDAQ basically rose parabolically right up until this point where it nearly hit 17,000 in late 2021. Now since then, the NASDAQ has actually dropped quite sharply and is now sitting below 13,000. This represents a fall of about 23%. So while we wouldn't call that a crash, it is a significant fall, and it looks to me that this high will most likely represent the top of this boom period that lasted since 2009. And if that's the case, that will be an extremely significant change. Looking at the daily chart of the NASDAQ, we can see a curve topping formation. So after this high period here, the price dropped sharply, but then tried to rally, but couldn't rally back up to the previous highs, and then dropped to a lower low, tried to rally again, and got slightly above this high here, which represents a bull trap because the bulls think that we're going to break out to new highs, but they get trapped as the price sells off from there. And we've seen a sharp decline, and there's been plenty of trading days recently where the market's been tried to rally, then got sold down, tried to rally again and got sold down. So it's actually looking very bearish. Now in an uptrend, you usually have a line of support where the price rallies above and then gets support at this level, rallies and gets support, and it shows the overall strength of the uptrend. So the opposite of that, in a downtrend, we'll often have a downtrend line where the market tries to rally but then gets sold off at these levels and then falls to lower lows, tries to rally again and gets sold off. So unless we see a major turnaround, the NASDAQ and the global markets are starting to look bearish, and in my opinion, the path of least resistance is downwards. If you want to see more detailed analysis on why I think the stock market might have topped already, check out this video here. Now, considering the stock market is looking bearish now, when we're at the very early stages of the multiple interest rate hikes that are forecast, it doesn't paint a pretty picture for the stock market over the next 12 to 24 months. When COVID hit, the Fed and other central banks implemented an ultra-loose monetary policy where they propped up employees, businesses, and the housing market. They implemented unprecedented stimulus measures, and they reduced interest rates to practically zero. Now that had the effect of putting a rocket under the stock market and the housing market, and some might argue that this was done intentionally, because when people see that their wealth has increased due to stock market gains and housing gains, they feel more confident, they spend more, which can benefit the economy. However, if this increase in wealth was artificially induced by the Fed and global central banks, then there could be massive consequences. You could go on a drug-induced high that lasts for days,
I wish this party could last forever.
but there'll always be a come down. And that's where the market currently sits, in my opinion. So we've had the worst pandemic we've seen in our lifetime. Business closed down, people lost jobs, unprecedented lockdown, yet the stock market and housing markets went on a bender. How can this happen, you ask? Well, printing trillions of dollars and sending interest rates to the floor was a pretty big cause. The trouble is, the party has to end sometime, and it looks like the fun's all over. So what does this mean for house prices? The housing boom in many places has really slowed down, and that crazy speculation, pent-up demand, fear of missing out seems to have subsided and exited in some places. In Auckland, New Zealand, for example, they've seen some sharp price declines. Boom periods never last forever, and even if there weren't potential headwinds or hazards for housing, you would normally get a flattening out after any strong rally. However, because this boom has been unprecedented in its strength, pent-up demand, and overall craziness, we may not see the flattening out and slight dip that you would normally see. I'm expecting much more volatility. Inflation in many countries is at 30 or 40-year highs. So this is not a normal situation we see ourselves in. And because of that, central banks have to hike their interest rates very aggressively to make sure that inflation doesn't run away and turn into something like hyperinflation, which can be devastating to an economy. Now, even though the Fed and other central banks say they're being aggressive, with CPI headline inflation sitting at 6, 7, 8%, the official interest rates are nowhere near that level. Many economists would say that you'd need to hike the interest rates to around about the level of inflation. So with the US having inflation around 8%, can you imagine the official interest rates being hiked up that high and what the corresponding mortgage rates would be? Central banks have a major dilemma. If they truly got aggressive with interest rates, it could be economic Armageddon. So for that reason, yes, they're going to hike interest rates consistently over the next 12 months. However, they're not going to want to crash the stock market or the housing market because that would definitely cause a recession, which means their economy would be going backwards. Now, the tricky dilemma for the central banks is if inflation continues to soar, they may have no other option but to crash the markets. And for that reason, I don't believe there's any chance of a smooth, soft landing for the economy. So whatever ends up happening with interest rates, we know that they're going up and quite sharply, and this will have a very large impact on house prices. If we consider that a lot of demand for housing occurred due to ultra low interest rates, then raising them sharply should see the opposite effect of declining house prices. Home buyers and investors just won't be able to loan as much money, and in many cases they won't be able to offer what the seller might be asking, therefore the seller having to bring down their price to get the sale. Now let's consider the stock market correction or potential crash. We talked about the increasing wealth effect when there was a boom, but when the opposite occurs in the stock market, you have a decreasing wealth effect. What that means is people see less money in their 401ks, their superannuation, their managed funds and other investments. People keep track of their investments, so when they see them decline significantly, they tend to become a lot more cautious, fearful, and conservative with their money. So this is the opposite situation of crazy pent-up demand and fear of missing out. The sentiment in the market turns fearful, it turns risk-averse, because people want to hold on to as much money as they can and not lose too much. This will have a large impact on investment into property, because investors who have significant wealth tied up in the stock market will suddenly become fearful and a lot more careful with any property investments they make. So for that reason, I think gone are the days of overpaying for property, because the environment will completely change from let's ride the boom to let's protect our money. The other thing I've noticed recently is countries starting to implement policies to improve housing affordability. New Zealand and Canada have banned foreign ownership of property. Canada has increased the tax on empty properties to 5% of the assessed value. And some countries are looking at applying a larger tax if you have over a certain number of investment properties. Now, because housing affordability is a very big issue across many countries, I expect these sorts of policies will continue, because with rents increasing, countries can't afford for a large percentage of their population to become homeless or really struggle financially. So we've got a number of factors all combining which will put downward pressure on house prices. This could end up being the perfect storm for both the stock market and the housing market. I believe we could see some significant falls in house prices, especially in those markets that had the highest amount of speculation. However, those falls could potentially lead to an actual crash in one certain scenario. And that scenario, in my opinion, is if inflation continues to soar higher and higher, because then central banks would have no other option but to ramp up interest rates, which will have a devastating effect on the stock market, the housing market, and the economy in general. So we'll have to watch very carefully to see how it all transpires. Regarding the buying conditions for houses, we've been in a massive seller's market where sellers can keep asking higher and higher prices, and the mass demand means the bidders have to usually go above what sellers are even asking for. But right now in many countries, it's turning more into a normal type market where there's good negotiation between the buyers and the sellers. You have a smaller amount of people negotiating for each home, and houses might sell at auction maybe half of the time. So I expect this normalized market to continue for some period, but if house prices start actually seeing some decent declines from all the factors we've discussed, then it's likely that the market will become a buyer's market. And that will happen when sellers have to reduce their price to meet the buyer's offers. There is less buyers or less demand for properties in general. Houses stay on the market for a lot longer, and we'll see some sharp house price falls. So I'm not saying that that will definitely happen, but it could happen if the right circumstances eventuate. So what do you think? Do you think this 2-year boom run in house prices is actually over? Do you think we could see 15% falls in house prices or even more? I'd love to hear your thoughts in the comments below. Whatever happens, I think it's going to be a wild ride. Hey, don't forget to subscribe to my channel. I would truly appreciate having you on board. I'm Biko Konstantinos, and I'll catch you in my next video.